one of the things that I discovered is that when I'm coaching and advising millionaires, the first question I ask them is, "Are you the first in your family to get to this threshold?" Because if your parents, if you've now surpassed your parents in income generation, in collection of wealth, then as much as you love your parents, their advice is behind you now, and it took me forever to realize that. So if you're at a certain stage, take a look at where you're getting that advice from, because I spent my and for our parents is really difficult because especially in different communities, in the Asian community especially, we have this heavy emphasis about respecting your elders. But when it comes to intellect, when it comes to finances, I've surpassed my parents. So how do I still show respect and love when my dad's trying to give me, investment advice? And I try to gently tell him, "Dad, I've got 2 decades worth of like Wall Street advice. I'm a licensed stockbroker for 20 years. It's like, you can't really teach me anything about how to be money wise, right?"
Yeah.
So you have to be gentle with that.
Welcome to the Share the Wealth Show, where minority professionals can learn to escape the racial wealth gap and catapult themselves into abundance. Your host, Nicole Pendergrass, grew her net worth from being negative to multiple six figures. Join her on her investigative mission to expose secret strategies of the wealthy so we can all have the tools needed to build the life and legacy we were created to possess. Now it's time for the show.
Welcome to the Share the Wealth Show. I just had the best conversation with Edmund Chien. Edmund is an experienced financial professional with over 15 years managing money for high net worth individuals. He is a former senior partner of a private equity firm that managed $500 million in assets for accredited investors and family offices. And in addition to being experienced in real estate syndication, Edmund is also a licensed stockbroker and licensed life insurance advisor. And his main focus has been finding new accredited clients and investor relations. But today, Edmund is retired from the financial industry and is a coach for client-facing real estate syndicators. He spent his entire financial career mentoring junior advisors and has been doing that full-time in the last 5 years. As you guys heard, Edmund has a wealth of knowledge, no pun intended, and he sat down and shared with us everything that this show is about: building wealth, investing it to grow it, and how to protect it on the back end. We talked about family offices. We talked about mindset, which is huge. They gave so many gems on how to grow your wealth and protect it. We talked about tax strategies. We talked about finding mentors and advisors, just everything. So you don't want to miss the rest of this episode. So stay tuned. We're starting right now. Hello, everyone. Welcome to the Share the Wealth Show. So I just went over a high-level overview of Ed's experience and his background. Ed, I just want to ask you, from all the plethora of things that you have done and you have achieved over your lifetime, what was it that made you transition from what you were doing previously? Like what caused the transitions and all the different points and aspects of your career growth and your career trajectory?
Yeah, I think a big part of it was starting off with curiosity and not being satisfied with being considered a neophyte or a rookie in that arena, and then just pursued after and just continued on to excellence. So interestingly enough, if you take a look at my background, I've just taken some drama classes in high school, and I ended up going to school for that. So I have a Bachelor of Fine Arts in Theater in Canada. So I went to the top theater school in Canada, which is like the Canadian Juilliard. And I ended up working on a lot of Broadway productions and things that ended up on Broadway. So it became a full career, became a full professional, or be considered a full professional in that. And then I switched over, and while I was doing that, the company that I was working for, it went under. So the big theater company, it was a publicly traded company as well. So I was stuck trying to figure out what to do. Now, while I was in school, I just entered, joined the military and enlisted in the military, really as this sort of like some interest. And I wanted to learn some good habits, or I wanted to learn some discipline and just experience life a little bit. So I did that through university, but it ended up becoming my fallback. So I ended up going full time for a little while, and once again turning into an interest. And I became a full time soldier for 2 years, and I was like a boot camp instructor. So I became a professional in doing that. And while I was doing it, now I'm getting salary, and I figured, you know what, I wanted to learn how to invest my salary properly and not waste my wealth, and start investing a little early. So I just started reading a lot about personal wealth and personal finance. I just cleared the shelf, the library shelf on money management, and I ended up turning that interest or hobby and becoming a fully licensed stockbroker. I was a private equity specialist and for real estate. And that's the last 20 years of my life. And I became a full-fledged professional in the industry. So I've done that like maybe 3 times now.
Wow. Okay. That's interesting. And you know what's so funny? I didn't even know that first part. Like I knew the military background, but I didn't know that you were in theater and drama for a while before, and like on the professional level. That's cool. Okay. Now, okay. This is a random question because I always have it, and I just assume that some of my audience may have it, maybe they don't. But private equity, I know what that means as far as raising funds for real estate deals, but I know there's a whole other private equity world out there. And what is that exactly? Like, what are you doing in private equity? Is that wealth management is considered the private equity? Are those terms interchangeable?
Yeah, that's a really good question. It's different. We call verticals in financial services. And stockbrokers, you would consider them like RIAs, so registered investment advisors. And their responsibility is to do wealth planning for somebody's entire wealth, including their 401ks, their IRAs, and investment accounts. And they're focused more on things like asset allocation and investing in public stocks. Now, in that arena, there's a small segment that you have for alternative investments. Now, alternative investments, in that category, you can have a section that's considered what we call private equity. So private equity is something that's not a publicly traded stock. So private equity means a private company. So what we end up doing is, so if somebody owns like a dry cleaners, or somebody owns a business, that person technically is running a private company or private equity because they own the equity component. Real estate, you can invest it in the same way. So in real estate, you can invest it into a real estate income trust or a REIT. So if you buy in a REIT, that is a public version of real estate. Or you could buy the same asset class without the public market and just create your own syndication in a group of individuals, and that would be considered a private equity. So that's a private equity arm inside the greater umbrella of wealth management. Now, as a side note, there's also a vertical called venture capitalist or VC. How VCs differ from private equity is the collateral. So in a VC, you'll have a lot of tech firms. So tech firms are a lot of ideas and innovators. But if you invest in that and the company fails, you can't foreclose on property. There's no bricks and wood there. So because there's no asset there, it's not considered a private equity. It's considered a venture capital. It's considered VC because there's very little collateral. The first collateral you could possibly get is IP, intellectual property, if they have patents, but that's about it. So it's a little higher return, or it's higher risk, and the multiples are higher than private equity. But private equity, you end up with more collateral or potential on the downside. Yeah. So my specialty was private equity as well as total wealth management, because I was a licensed stockbroker as well.
Okay. So you did private equity and the RIA. You were both.
Yes. In private equity, you can break it down a little bit more. So private equity, you can have private companies and you can have real estate. So my private equity experience was primarily focused, like 90% focused on real estate.
Okay. And real estate, meaning in your capacity, you would be investing clients' money into REITs and other things. No. Or would you also do syndications?
REITs are public.
You're right.
So
all right.
In the private equity side on real estate, we would be putting in, here in Canada, we call them real estate limited partnerships. So we put it through LPs, not LLCs.
Okay. Perfect. Now, between REITs and syndications, do you have a preference for building wealth, and why or why not, if you had to pick between one of those two?
Yeah, 100%. I'm a full private equity guy, even though I was a licensed stockbroker. I'm true to the bone. And the reason why I like that is you have a lot more control. What I don't like about public markets is that you can have hedge funds that come in and short sellers, essentially, that can come in and clip your returns. Because when you go onto an open market, you can't control who comes into your deal. Anybody can buy your deal if they want to. And there can be people that are trying to exploit an opportunity, or they'll come in and short sell and then try to ruin your reputation just to try to drive your stock price down. When you have a private company, I interview every single person I let into the deal. So if there's somebody that I think, this is not going to be a great person to put into this project, we don't want to put them into this deal. One of the things that we had in our private equity firm is we had a minimum, but we also had a maximum. That protects everybody, including the GP, as well as all the other investors. So you have a lot more control when it comes to private equity. The other component of PE or private equity is the price to earnings ratios tend to be lower. So price to earnings, a typical price to earnings on a public stock is anywhere from 15 times earnings and above. So it goes to 15 to 40 times earnings if you take a look at average PE ratios. PEs on private assets tend to be more around the 3. And what PE basically means is how many, what's the price times earnings, right? So if you're going to go and buy a whole company, so say you and I wanted to go out and buy a dry cleaner, a typical price to earnings would be, you take a look at its earnings, and it's usually 3 times earnings is what the average price would be for a private company. You have to buy the whole company. But when you take a look at a public stock, we'll be paying 15 times earnings. So if you take a look at like Tesla's a ridiculously high PEs, right? So you're paying a ridiculous amount more than if you were to buy it privately. So my preference is to buy the assets privately because you get it at a better price. I'm a value investor. So that's my philosophy is I'd rather buy assets at a better price. In public stocks or real estate income trust, I can't control that. The PEs tend to be higher. So the prices, you're over, in my view, you're overpaying for that asset.
Okay. And that's exactly why you get such a much larger upside if you are on the VC side of a company before they IPO or anything like that, because you took that extra risk, but your PE is going to be lower as well.
Yeah, PEs really aren't considered in a VC space because they don't have any earnings. They're pre-earnings. So that's not a metric. So what happens in a VC space is that because of the risk, because we don't know if it's gonna go to market or it's basically rolling the dice. So because of that level of risk, we expect a much higher multiple in returns. So a typical return in a VC space is anywhere from 10 to 15 times our investment, whatever we put out in 3 to 5 years. And that's early money. So like seed money or very early money.
Okay. All right, cool. Wow. I already learned so much just in the first, I don't know how many minutes that was, 5-10 minutes. So that was crazy. Also, okay. So I guess for the real point of this show, right, is to give the listeners some type of insights or information for their own wealth building and wealth plans to create generational wealth, to create wealth that they can even access and enjoy today. I know you've had tons of clients. You have years and years of experience. You've seen all different types of investment strategies and things that people use, like vehicles, things that they invest in, whether it's a combination of life insurances, maybe the stock options, like you're saying, VC, just like all the gamut of all the different avenues that someone could use in order to build wealth. If you are non-accredited, or maybe you're right at the edge and you haven't crossed that threshold yet, you make less than $200,000 a year, or you have less than $1 million in net worth outside of your primary home. For those who don't know what accredited standards are, those are it. And if you are right below that, or maybe you're even working your way up, maybe you're way below it. In either case, how could they get the ball rolling? What's some foundational piece that they should maybe look into first as far as an investment vehicle that's a great way to help them build up to bigger investment opportunities that they may not have access to now?
Yeah, there's a lot to unpack in sort of that discussion. I think a big part of it, learning what you don't know and being able to figure out what you don't know. And I think that especially for visual minority communities, there's a bit more of a challenge there, because I think a lot of it, there was a pivot in my life. So my parents immigrated from Hong Kong in the 70s, and they came to Canada. I'm born and raised in Toronto. And when I was young, I would get mentorship from my parents, and my parents would give me all this advice and tell me. And what my parents was able to do was help me figure out how to get a great job, how to get an income, how to get an education, how to get a degree, all these types of things. But then there came to a point where and this is a struggle for a lot of people that become accredited investors that essentially amass $1 million. Their first million is really challenging to get to. It's probably the hardest million to make is the first million. But one of the things that I discovered is that when I'm coaching and advising millionaires, the first question I ask them is, are you the first in your family to get to this threshold? Because if you've now surpassed your parents in income generation, in collection of wealth, then as much as you love your parents, their advice is behind you now. And it took me forever to realize that. So if you're at a certain stage, take a look at where you're getting that advice from, because I spent my and for our parents is really difficult because especially in different communities, in the Asian community, especially, we have this heavy emphasis about respecting your elders. But when it comes to finances, I've surpassed my parents. So how do I still show respect and love when my dad's trying to give me, investment advice? And I try to gently tell him, Dad, I've got 2 decades worth of like Wall Street advice. I'm a licensed stockbroker for 20 years. It's like, you can't really teach me anything about how to be money wise, right?
Yeah.
So you have to be gentle with that. So the next phase to get to that is recognize, who do you want on your sort of personal board of directors? And are they qualified to be there? Because the people you want to get that advice from, are they where you want to end up? Or are they where you used to be? So if everybody on your board of directors are your aunt, your cousin, and they haven't amassed as much wealth or success as you, why are they on your board of directors? It's like you can still have a personal relationship with them, but when it comes to career advice or wealth building advice, they're probably not qualified anymore. So you've got to look for other people to mentor you. And if you can't physically find somebody that's there that you have connection with, then I started replacing it with books and people that have done it. Like start with Rich Dad, Poor Dad, read all this other kind of material from people that are where you want to be and use them as your board of directors until you can find great mentors and great coaches to help you.
Okay. Yeah, I actually was just about to interject and ask that. Okay, how do you get someone who's way ahead of you to want to be on your board of directors when you're not there yet? Because now they're reaching back behind them to help, you know what I mean? And sometimes you can find somebody who has that ethos that they want to actually help someone else rise up. But if you are still trying to grow, how do you get that person to want to be on your advisory team? But if you can't, like you said, books are 100%. But that question still stands. Do you have an advice for getting someone who's ahead of you to kind of help want to advise you?
Yeah, absolutely. So I'm trying to help everybody that's out there doing this. And what I coach and I explain to every professional is that no matter where you are in life, somebody else wants to be where you are. Somebody's struggling to get to where you are. And this is one of the reasons why there's so much imposter syndrome and limiting beliefs. There is a benefit to the individual that wants to coach other people. So if you want to mentor somebody, pick somebody. I tell people you should always have a mentor and you should always be mentoring somebody else and just giving them some tips and advice. And when you take a look in the mirror, a lot of us tend to say I'm nobody special, especially if you have like teenage kids. You hang out with a teenager and you feel like you're the biggest idiot on the planet. And you start to get these limiting beliefs, like I'm nobody special. But when you mentor somebody, I remember mentoring some kid that he was doing me a favor and I was going to mentor him a little bit, just trying to get into financial services. So I was giving him some tips and he stopped and he looked at me. It's like, man, what I would do to be who you are, what you've achieved, you know so much. And it just blew me away. And it's like, wow, it's like, I actually know a lot of stuff. And this kid wishes he could be me. And it was really gratifying. I put stuff down in my gratitude journal. It's like, don't forget that you've achieved quite a lot of success. So we tend to forget that. We tend to focus too much on what we don't have. And overconsumption in the Western world has taught us that. If you just take a look at the ads, they're like, you're not good enough unless you use our soap. And if you buy our soap, you're not good enough unless you use our shampoo. And we're bombarded with that for our entire lives. So we always feel that we're not enough. But when you start mentoring somebody, those people will show so much gratitude in return, especially if you do it for free. They'll show so much gratitude in return. And they'll say, like, I wish I could be you. You're so knowledgeable. And it's a great reminder. So always be mentoring somebody. And that's the benefit of somebody. When you go and look out for a mentor, make sure that you don't waste their time. So for me, when I look for somebody that I'm mentoring, I want to give a whole bunch of advice, but I don't want to throw my pearls before pigs. So if I give you all this advice and you take it and you go nowhere, that relationship will start to probably wind down. But if I give you some advice and you're able to take it and you're like a rocket ship and you just run off with it, that is incentivizing. You know what? You're not wasting my time and you're not wasting my advice, and you're going to make something of yourself. And that's gratifying for me. And I would love to help people succeed. It's this mindset of abundance. And that's the value that a mentee can provide to a mentor, which is this concept. And the way I do this is I was taught a high tide raises all boats. So if like I was an immigrant and I never went to private school, I never got access to these great, because I remember being an RIA, there was another advisor that was linked into a very wealthy community. And there's no way that I would be able to break into that. I'm like a kid of immigrants, so I don't have that upper class kind of connection. So, but he was able to bring in tons of money. And I thought to myself, or people told me, like, well, you need to find a really successful community like that guy did. But if I found a really successful community, I would be an outsider. They wouldn't really let me in, right? And it would be very difficult for me to be considered one of the club. So instead of that, what I realized was, why don't you make a successful community around you? Connect people, and a high tide will start to raise all boats. And if you can surround yourself with really good contacts and help other people succeed, they become successful. You've now got a network of successful people all around you that owe you a favor because you help them succeed. And it's not just one person. Imagine having 80 people around you like that. And now you've got this incredibly successful community that you built. And that's the mindset of why you should coach other people, to help build them up. And because when I mentor people, I want to make sure that you're successful, because one day, that success, I might end up working for you because you got such a great idea. So I'm trying to mentor you now while I still can, because eventually I hope that you would surpass me. And that's just not one person. If I could do that for 60 people, then eventually we all help each other out. That's what I'm looking to do. And I think that really good mentors have that understanding as well.
Okay. Yeah, that's actually everything that you just said is everything, because adopting an abundance mindset is really hard in this society, because everyone thinks that in order for you to win, I have to lose something. And that's not what abundance is about. It's about helping everyone, and that there's enough in the universe for everyone to succeed. And especially when raising private money for syndications or things like that, it's like, oh, I keep my investors close to my chest because I don't want someone stealing my investors, right? So I understand that you do marketing and you do a lot of outreach, and maybe it takes a while for you to build up your investor list, but that's also a limited mindset. That's a fixed mindset that you won't have new investors, or that the money for deals that you need won't find its way to you if you don't, do things ethically and keep up, transparency and communication, and just be a good person, and things will happen in your favor when it's time for it to happen. And sometimes you have to put feelers out there. You don't know when that will come back to you, but you have to have faith and believe that you're on the right journey and you're on the right path. And just to also add to that, I'm reading The Gap and the Gain right now, and literally completely changed my ethos. And I'm a optimistic person, right? And that just changed it. It filtered the way I thought about comparing and my journey, and being grateful for where I am today, and not so focused on the goals that I haven't reached yet. And I think it's if anybody has not read The Gap and the Gain, you definitely should. It definitely changes the framework in your mind about how you look at your current situation and being present in the moment. So thank you for that. And I think we were on the journey to, I was talking about foundational investment pieces, and we got on the tangent. Mindset is such a critical point to this, regardless, you have to start with mindset. So I'm glad we went down that rabbit hole. But yeah, I think we're talking about foundational investments just to get people started.
Yeah. So I think a big part of it is that if you're taking a look at the progression of wealth building, the first foundation you start off with is learn how to be successful at working for money and increase that efficiency. So that's being great at your W-2, getting an education, great W-2, perfecting that, and getting to a decent salary. Now, once you get to that phase, that's when I say, okay, now you've take a look at who you have on your board of directors and who do you have as a board of your advisors. And are they able to get you to the next phase that a lot of people end up missing? So a lot of people get stuck into this great W-2. They're making $150,000, $200,000 a year. They think they've made it because all of their surroundings and their family, and especially if like me, if you've got immigrant immigrant parents and just kind of stay there and you just kind of do that for the next 40 years of your life. But if you start reading this finance material like I started doing, it's like, no, there's other phases beyond that. You can keep going. And the next phase beyond creating or working for money is now turning your money to work for you and start leveraging it. That's adding that leverage piece is going to get you to your first million much faster. So you work on your day-to-day, you work for your W-2, but then you also have your money start to create cash flow, passive cash flow for you as well. And it's duplicating that cash flow for you. It's like duplicating yourself to the point where some people now start to make more passive cash flow in their investments than they do at their W-2. Well, once you get to that phase, congratulations, you're retired. Right. So you don't have to retire, but you no longer have to work for money. Just work because you want to, not because you have to.
Nice. Yeah. I love it. Yeah, definitely makes sense. That's what I'm in the journey of doing now. And I'm building it up and I'm grateful for where I'm at now because I've come so far from where I was before, but just want to help other people just realize and open up their minds and be more thoughtful and intentional about moving forward and creating that plan for their future and just knowing all the details and not just going with the flow, what the sheep and the herd are doing because it's easier. Sometimes the system is set up to make you do things that it wants you to do because it's more profitable for them and people who are higher up. And you think it's a great idea as everyone else is doing it. And it's just something it's easy to implement, but they make it easy to implement for a reason. So that's why it's so imperative to get people like yourself or whoever else as advisory and on your team and increase your knowledge base and really start digging into that information so you know what to look out for in the future. Okay, guys, don't kill me, but I'm going to have to cut this episode short. This is too juicy and we need to do this in a part 2. So stay tuned for the next episode that airs and you can hear the rest of our conversation.
Did you love this episode of Share the Wealth Show? Be sure to connect with Nicole by following her on LinkedIn, Instagram, or Facebook. If you picked up any of the gems that were dropped by today's guest, make sure you not only put them in your bag, but if you know of someone who would benefit from this information, don't keep it to yourself. Share the wealth and make sure to leave us a rating and review. We'll see you for next week's episode. Subscribe so you'll be notified.